I hope you enjoy. And good morning to Propenomix people tuning in on the YouTube and podcast platforms. Thanks for tuning in. If you've watched before, you'll know that I like to start these streams with a quote. And this week's prediction is very difficult, especially if it's about the future. That was from Niels Bohr, the physicist, and clearly also fancying himself as a bit of a comedian. But this week's is called Adjustment Time, because we've got to that time in the calendar where most of the houses and various places that forecast things about the UK property market have had a look at the first half of the year and worked out just how much they need to revise their predictions by in the first place. I don't tend to do refreshed predictions at this time of year. I try to do what I can in December for the year and then see how I get on throughout the year, being one of the very few forecasters that tries to hold themselves accountable to what they said, and more importantly, why they said it. And then, as things change, I might change them throughout the year rather than waiting for any particular sort of halfway through event or anything like that. But the quote from this week was about the subject matter of this week's deep dive, because these adjustments that have been made need a bit of scrutiny. Some of them are quite bearish, actually, in the immediate short term, but I think we're in for an interesting few years in the property market, which I'm going to go into here. But before I go in full hammer, Rod Turner and myself will be running our next property business workshop on Wednesday, the 1st of October in London. The subject matter this time is investment, with an emphasis on what metrics you really need to be considering to run your property business properly and building your business to scale. We're digging into the real fundamentals of property investment for growth, from proper valuation and strategic debt structuring to the investment metrics serious pros use. Hint, you'll be ditching ROI and yield. Learn why some deals work for some and not others, how to manage risk as your portfolio scales, and when to shift gear from side hustle to scalable business. We'll break bottlenecks, build strategic pillars, and unpack real-life case studies of fast company growth. How have we done so many deals? Well, we'll tell you. Book the super early bird tickets with the 20% plus off the face price now at bit.ly/PBWEIGHT, and there's also a link down in the show notes. So, cracking on with the body of the supplement, Trumpwatch. We're getting a closer view as the Donald goes to check on his golf course portfolio. Personally, I don't play golf, but no one would mind doing their own inspections if it was a golf course portfolio, let's face it. And there's also a sniff of an EU deal settling the tariffs at 15%, down from 30%, which was his latest quote. But in the same sentence, a hint that actually negotiations are still ongoing with the UK. I mean, I thought we were all signed up, didn't you? A little bit disquieting for those who banked on him meaning what he said when a deal was already done. Or was it? Always so difficult to tell. In many ways, though, I suppose negotiations are always ongoing. Tariff deals done this week included Japan at 15%, the Philippines and Indonesia both snagging a 19% deal. The IMF, and they have been in the press this week for talking about the UK, aside from anything else, published their expectations that Trump's tariffs cost the UK 0.3% of GDP in 2026, which is unfortunately a huge slice of our probable growth, such as our overall anemia at the moment. On the bright side, they revised their UK growth forecast in 2025 to 1.2%, which I think is quite brave in a sideways economy and a volatile environment. I rarely concur with the IMF, though. It should be noted. For anyone in any doubt, I'll be betting under on the 1.2% for 2025. That flame war with the chairman of the Federal Reserve, Jay Powell, continued. Most who are watching think that Powell will be able to see out his term before being replaced by a Trump stooge who presumably will have one singular brief: get the interest rate down. If that means breaking stuff, do it. How? Well, the smart money says yield curve control and the Fed buying bonds in whatever volume it needs to, wherever it needs to in the yield curve to get the price down. Think Japanese tactics over the last 20 or 30 years to an extent. Over to our main subject matter, the real-time UK property market. Chris Watkin was back after a hiatus last week, so week 28 has now been reported on. Listings printing 34,300, a slight drop from last week's 35,900. Still 4.4% above 2024 to this point, and 7.2% higher than the pre-pandemic market. So my sort of 10% more stock than a normal market ready reckoner is getting a bit stale, although it's not far off actually, because obviously we had more listings than usual last year as well. So we've got a surplus amount of properties on the market, although properties don't just sit on the market forever. As you'll know, things tend to change from time to time. We're still 13.6% ahead on listings of the 9-year average. But that 9-year average does include 2020, which does pollute the figures a little bit. But we're limping around the average number of listings for this time of year. We're not really forging further forward into even more listings than was already historically precedent. But we're still listing more than we're selling, ultimately. So we do need to bear that in mind. Although we know from recent analysis that only about 50% of what's listed actually gets sold, which is just a mind-blowing statistic when you think about it. But that's what the figures say. So 25,600 price reductions, 14% of stock was reduced in June. 2024's was 12.1%, May's was 13.4%, but the 5-year average is 10.6%. So more stock, more reductions. That's in absolute numbers and in percentage terms as well. On top of that, 33% more reductions than the 5-year average. That's the difference between 14.1 and 10.6%. 25% more reduced properties than a normal market has been working as my ready reckoner for a few months now, so I'm staying there roughly. 1 in 7 properties on the market are being reduced each month. So we're running at a little over 100,000 price reductions per month, to be clear. If you're telling me you can't find a deal, you just need to keep the legwork up and you'll get there. 26,300 homes sold subject to contract. Healthy is still the watchword. SSTCs are up 7.6 year on year and 14.6 on 17 to 19. So if you think listings are up 4 point whatever from 2024, but sold subject to contracts are up 7.6, looking a fair bit better. We're still nearly keeping pace with 2022, which is no mean feat because 2022 was a very hot market indeed up to this point in time. We went into July with 758,064 homes on the market, which is just a teeny increase on June's number, which was nearly 757,000. So as the market got a little bit stickier before the pandemic, and it was a little bit flat, a little bit sideways, if you remember 2019, we had 660,000 homes on the market. A seller's market would look like more like under 600,000 homes on the market. And at the end of June 2024, we had 700,000 homes on the market. So there are more higher highs. Those extra listings are sitting there and creating a bit of a clog. But then we'll get an August clear out at some point, because we always do. Not as big as the end of the year clear out that we get on the market, as people give up because they can't get the price that they want apart from anything else, or they're just not enjoying the process and they decide to stay put. But it's all higher highs at the moment, just about. And so the flat feeling I've been talking about over the next few months is still quite likely to manifest itself. It's a steady market. It's not a problematic market. Stuff that's priced well is selling. That's what's going on. We're very nearly at a pullback. I've been waiting for this pullback moment to start calling where the top might be in this amount of stock on the market. And we've had weeks and weeks now, actually, of listings not being as high as they were in 2024. So I feel that we are nearing that peak, actually. It's difficult to read too much into August because of the holiday month. And there's always an extra surge of listings in September when the school holidays are over. What you normally see is the asking prices spike massively and some expensive stuff down south goes on the market after everyone's decided no more school holidays in this house, or whatever it is that drives that September push. Just a bit of a change. New school year, new start. I imagine that sort of thing psychologically has a big impact apart from anything else. But let's see those figures before we draw too many more conclusions. Now, Chris also likes to look at the per square foot on sold subject to contract properties because it's got a very, very strong correlation with the prices that hit the land reg in 5 months' time. So in this time round, June was at £346.45 per square foot, which was 2.46 above June 24, but only 1.48 higher than June 2022. Which was the previous peak. So we've only seen on that metric a 1.5% increase in house prices in 3 years. Now, of course, it didn't manifest 0.5% a year. It went down a bit in 2023, came back a bit in 24, and has moved upwards since then. So we're moving up. But if you take the 2.5% as roughly correct, because there is a strong correlation, then what you're looking at there is a number that's about 1% below inflation, a number there that's about 2.5% below wage inflation. So a very, very sustainable drag upwards that's only really being driven by inflation at the moment, rather than any really strong market forces, because this amount of supply, aside from anything else, is dampening down what's going on, and just meaning we're seeing more transactions at the same money rather than an increase in house prices. As a rule, it's not binary, so you do need to bear that in mind. So I think we'll hold on to this about 2.5%. My prediction was 3.75 at the beginning of the year, so that'll be shaving off about 1.25%. I'll be reasonably happy to be within that sort of range. I won't be unhappy to be out on that front. There's been some starker revisions this year, which we'll see later on. And then fall throughs just nudged above their long-term average. The long-term average is 24.2%. So we had a 24.7% print, and it was 25.9 the week before. But it just looks like pretty normal noise. You're not going to read too much into that, I don't think. The net sales are still playing ball. We're still 5 point up for the year, 5.8% up on last year for net sales. And we're still at a 10.5% higher level for net sales than 2017 to 19. So we're not at 2022 levels, but the stamp cliff will have pushed a few transactions out of bed. And as the year progresses, in the absence of any more shocks, things will likely catch up, because we had a big disturbance in late 2022. You might remember, after the budget, and then the bond markets volatility after that in comparison. So I always like to give Chris a weekly shout out here, because he's more prolific than just this epic tome he releases weekly on the UK property market. He comes up with great stats on a regular basis. He's a great guy. I'd encourage you to drop him a like, a subscribe, and all the rest of it, and some kind words for his content creation. And if you're in the industry and you want support in growing your business, or to be a more effective communicator, be more in touch with your local market, because that's his core business, then give him a shout. His article's published on the Property Industry Eye website, and the video on his YouTube channel, which is at Christopher Watkin. And while you're at it, if you wouldn't mind giving this video a like, leaving me a comment, and subscribing to the channel if you haven't already on YouTube, I would also appreciate it very much. Thank you. Okay, we'll go into the macro brewery now to see what flavour output we're going to be dealing with this week. We had the flash PMIs this week, and anyone who listens regularly will know just how much I like to look at these for a real-time indication of the health of the economy and the private sector. We have to look at Rightmove's house price index, which was published this week as well, because there was another big fuss caused when it came out on Monday. UK Finance also released one of their new format reports on buy-to-let lending for the first quarter of 2025. A little bit slow, I know. I don't know why it takes nearly 4 months to produce these reports. Seems a bit of a long time, but nonetheless, we'll look at it anyway, because it's good to see the health of the buy-to-let lending market. And then, of course, we'll round off with the gilts and swaps in a week that was a pretty miserable week for the Treasury in general. But the flash PMIs then, our first look for July. Last month, we saw a large revision upwards after the flash numbers, and we hope for more of the same again. The composite index was down to 51 from 52. Services only printed 51.2, where in June they printed 52.8, as we were looking at a miraculous recovery back to a healthy economy. Manufacturing limped back up to 48.2, which is still under 50, so it's still contracting, but it's actually a 6-month high, because manufacturing's had a miserable time post that budget that we had in October last year. So the tale of the tape, as you can likely tell, is pretty well summarised, as it usually is, by Chris Williamson, who's the chief business economist at S&P Global. The economy is struggling to expand. The growth rate currently is congruent with about a 0.1% quarterly GDP growth rate. And he sees the risks to the downside on that number rather than potential to the upside. What are the basic problems? Subdued confidence, deteriorating order books, rising costs, and the last budget still taking the blame before the next budget, in my opinion, starts to have a further impact on confidence. Although confidence is pretty flat, having said that, right? It's pretty flat, has been flat for months on almost all metrics, consumer and business. Confidence looks very flat. It's negative and flat. July's impact on employment headcount is described as sharply reduced. Now, they always finish these reports by telling the Bank of England Monetary Policy Committee what to do. And his comments this month do look particularly sensible. Pressure's on to cut rates in August. They're now at 80% likelihood to happen, down from the 90% racing certainty that was being priced more than a week ago. We've got low growth. We've got the labour market going the wrong way in terms of unemployment. And so these trends become a little bit more important than the inflation narrative in the short term, because you can write price rises off as transitory, effectively, thanks to the employer's NI rise amongst everything else. Although Andrew Bailey, and I do agree with this actually, Governor of the Bank of England, said in the past week that people psychologically are okay until you get to about 4% inflation, and then they really start to get quite concerned and change their behaviour and things like that. So it does make sense, because people do look at, like, you know, I talk about decimal places and finer points of data all the time, but people in general, think of a property auction, for example, they tend to think in £5,000 chunks. They don't think in £10 chunks, for example, as I might do. So is it transitory rises in inflation? We're obviously concerned about that word, because that's what they said back in 2021. If you remember, this bit of inflation was transitory, while people like me were screaming, it's absolutely not transitory. What are you guys playing at? It's risky business, in my opinion. Some of the Monetary Policy Committee will no doubt comment on this directly, including the Chief Economist, who's very much been in the camp of, yeah, let's not just put the rates down quite so much, quite too yet. Let's see what happens. But there's one more piece of the jigsaw screaming sideways, I'm afraid. So what about Rightmove? Well, month on month, asking prices on Rightmove dropped by 1.2%, meaning an increase in their whole index of asking prices has only gone up 0.1% year on year. Let's just pause a second. Asking prices. We know, and I've been saying it for a long time, I've already said it today, that to sell houses in this market, price is a big driver, because there's a lot of supply on the market. It's significant. There's more houses on the market than there's been for a decade. And Rightmove asking prices, which still sit above £370,000 on average, are miles ahead of anyone's idea of the average house price in the UK. We're still below 300,000 on that metric, according to the ONS, according to the Halifax, and according to the Nationwide. So I wouldn't see this drop in asking prices as panic stations. It just feels like pretty sensible negotiation tactics in order to actually sell for those who are suitably motivated to actually sell their properties. Now, what about geographically? Where drove this chunky adjustment? I think you know where I'm going to go with this. London asking prices were down 1.5% this month, and inner London was down 2.1%. When you get into the regions, the very expensive parts like Westminster and Camden were actually down more like 2.5% or more. So those who actually do want to move their stock on in those areas are starting to look a bit more motivated. And also, as noted in the summary, sales agreed are up 5%. Buyer demand, which is measured by future buyers contacting agents, is 6% up year on year. And affordability has once again definitionally improved, because apart from anything else, inflation and wage increases are comfortably outstripping house price growth at the moment under anyone's measure of that. If we stick with Chris's 2.5%, which I think is a pretty good stab of where we are, as I said earlier, we're still 1% below inflation and 2.5% below average wage growth. So pretty good. So they cite the 2-year mortgage on their tracker, which is Rightmove's tracker is one of the more accurate ones in the market at 4.53 for buyers, and they herald an improvement on last year's 5.34. Now, this is much more a readjustment in the yield curve, as I've talked about over recent weeks, than it is really anything amazing happening for 2-year mortgages or margins being driven down or whatever. But it's basically that's the benefit of the short end of the yield curve flattening. We're now getting much more reasonable 2-year prices. So if people think we might have a pretty good 2 years, or a lot of first-time buyers going at 2-year anyway, then they look to refinance or even consider moving. Probably a little bit over-optimistic in how often you can move and how expensive that is these days when you include things like the stamp duty, aside from anything else. But Rightmove thought we'd have a 4% increase at the start of this year. And I think that was one of the most positive predictions there was in this market, actually. I think Savills were up there as well, as I'll talk about later. But they now think we'll be at 2% increase for the year, which is fairly sensible to me. My range is now 2 to 3%, as I said. So 2.5 smack bang in the middle of that. They also predict the number of transactions, and they're pretty good at doing that, as you'd imagine, because they see what's listed, they see what's sold, they see what's withdrawn. They predicted 1.15 million transactions, We had about 1.1 million in 2024. They're sticking with that. I think that looks right. It might even go up, nudge up a little bit. We'll see. Rightmove also points to the fact that markets expect 2 more interest rate cuts this year. We've already talked now about how August is probably pretty much nailed on, aside from anything else, more because of the weakness in the economy than the fact it's time to put the rates down again. Not so sure about the second cut myself yet. I think we'll have to see, because I still think we've got rising inflation even more. And if we are bumping our head towards 3.8, 3.9, given what Governor Bailey said about 4% being a bit of a magic number, I think he'll be keen to see that going downwards before he leads the charge to cut rates again in the short term. But August does still look a near certainty anyway at this point in time. So let's see what happens. I guess, I mean, they would expect these cuts to stimulate activity. I get a little bit pedantic here because I'm not sure that the 5-year is going to cut or drop a lot in terms of its rates. If we do see those cuts, the 5-year swap is already 35-ish points below the 5-year gilt, so it's as low as it's been. That discount on the 5-year gilt is as generous as it's been for years and years. I'm not sure that these rates cuts that are pretty much already priced in anyway are really going to drive those mortgage rates down, but let's see what happens. There's also all the other exogenous factors and what the US are doing, which is more likely to lead our yield curves one way or another. I think we'd need a change in language from the Bank of England about longer term. We might even need a change in language about fiscal policy in the longer term, but I don't think you're going to see that in this administration, this Labour government, because they don't really have appetite for the tough stuff that we all now know is true and is hitting the headlines day by day, that we really can't afford to run the sort of economy that we're running. But anyway, let's not gloss over the bit that made the headlines. This drop of 1.2% in asking prices for July was the largest in over 20 years of Rightmove data. Their analysis suggests it's a bit more pragmatic. As I was saying, it's about getting sales done. It's not about a slower market, it's just about a glut of supply, right? It's the fastest market for transactions, ignoring the stamp blip, since the same time around 3 years ago, before you know who did what you know she did. Before, plenty of motivated buyers, though, as is so often is the report on the ground. First-time buyers tend to be super motivated people, right? So this is a market driven by you making the right choice and also maximising the opportunity. I think that's a better way to frame it. They do talk about non-doms and the likes stalling in central London, but they point out that the rest of Great Britain is 90% of the market. London only represents 10% of the market, right? Central London does. The North East, for example, has an increase of 1.2% in asking prices this month. So the North East has gone up. So once again, the macro headlines are better striated regionally for proper analysis. Every other region is flat, like the East Midlands or Yorkshire, or down, I should clarify, with the Northwest and the West Midlands both dropping more than 1%. So they're near that average drop in prices. So perhaps some steam is coming off the top of what's been an incredible bull market in the past few years in the Northwest. There's been a few recent figures just suggesting that. So if you think, Manchester and the surrounds is going to go up forever, I'd encourage you to be a little bit cautious at the moment, because it does look to be flattening out at the minute. But better that it flattens out and takes its time than it booms and booms and busts, let's face it. So panic is probably postponed, because all the sensible analysis below the surface is detailing a healthy market and not one that people are going to sit around waiting in. Unless you're selling typical properties in Westminster or Camden, as I said, I wouldn't worry too much. And if you've got a portfolio of typical properties in Westminster or Camden, I'm not too worried for you anyway, because I'm sure you're doing okay. But just remember, it's a price-driven market, even more than usual. I do think we're close now to peak supply. It feels more and more like that as the weeks roll on, watching this data every week. Listings are slowing down compared to last year in the week-to-week comparisons. Is there going to be a flurry of activity to end this year? I think not, because seasonal factors always take over in December, but you do get the feeling 2026 could open rather bullishly the way things are shaping up. All this market needs is some momentum to drive some FOMO, fear of missing out, and prices will be on the way up, 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 in my view. Okay, let's flip over to buy-to-let only and what UK Finance had to say about buy-to-let lending in Q1 2025. The report was met with a fanfare of resurgence from a very miserable 2024 quarter one. Loans were up 38.6% in number and 46.8% by value. This wasn't yield driven, though, according to UK Finance, because yield, they see it 6.94 versus 6.88 from a year ago. So was it rate driven? Well, they report rates down 0.1 from quarter four 2024 and 0.41% down from quarter one 2024. That's not hurting, obviously. Average interest cover ratio, 202%, up from 190 1 year before. So there are 1.44 million fixed rates. So what you're saying there is effectively the mortgage is about half of the rent. That's it. That's a real rule of thumb in terms of what UK Finance see across the board in buy-to-let. 1.44 million fixed rate buy-to-let mortgages with the fixed rate ones that are outstanding. That's where we were in quarter one. And then only 500,000 outstanding variable rate buy-to-lets. Arrears were down once again. So 780 cases down. We're at 11,830 buy-to-let cases, mortgages in arrears of over 2.5%. Repossessions were up, though, because they're still lagging behind arrears, and arrears have been rising up to a point until about a year back, right? So 810 possessions of buy-to-let properties, to put the whole thing into context, in quarter one. Sounds fantastic, right? Not really. This summary just provides a significant lack of context for me because it's just a boilerplate year-on-year, quarter-on-quarter style report. The longer form report they produce with the source data is much more of interest, showing that we're still below 2019's new buy-to-let loans, let alone the peak of 2022. Now, that's just in value as well, right? So measuring loans by value, and bear in mind prices are up at least 20% pretty much anywhere in the UK over that period of time. The number of loans actually looks like 20-25% lower or so, right? So context is still super important. It always is. And buy-to-let still has its wings clipped significantly compared to recent history. Okay, let's get into our guilty pleasures for the week. Another miserable month's figures in the can for the Treasury. We're borrowing more than any other economic consensus is noting that we will borrow. Now, you might know I've also been following the OBR monthly commentary as well. That was out this week. They're the only forecaster that matters, arguably, right? This ugly looking June took us to exactly where the OBR forecast said we would be by now. So we're absolutely spot on the OBR borrowing forecast for the months of April, May and June, the first quarter of the financial year. But we did have a few billion quid of headroom against the OBR forecast before June's figures were in the can. So as it is now, all that headroom has gone. So that's not as bad as it sounds in the press. We're on forecast for how much we would borrow, but we've also had no luck, really. When you look at the OBR forecast, we're actually getting quite a lot less in VAT than they expected, which is probably reflective of consumer confidence, apart from anything else, but actually more than expected in corporation tax and national insurance, in spite of the rise in the latter, which of course would have been baked in to the forecasted figures that the OBR knocked out for this financial year. We, and Rachel Reeves for that matter, certainly need a reversal. The bad news was compounded this week as we issued more index-linked gilts at a 1.588% yield above inflation. And remember, linkers are above RPI inflation, not CPI that we use these days as the inflation target. What are we playing at issuing more of these gilts? Some 15-year bonds sold at a 5.066% yield. Last time they were out by the DMO, the Debt Management Office, they were at 4.85%. Bond investors are enjoying juicy returns for what they are, what the risk is, and what the effort required is. That much is for sure. They're gambling against inflation, ultimately, aren't they? But the shocker and what caught everybody out was this, in terms of the monthly figures, was this gigantic payment on the index-linked component of the gilts this month, which was a huge uptick. Last month it was 1.9 billion, and this month it was 10.9 billion. So clearly the forecasters are not looking at the months where the index-linked gilts are actually paying their interest when they're making their forecasts, because this really shouldn't have been a surprise if you did your forecast correctly on that side of things. But what we've done, if I explain it basically, is that when we've needed significant debt in recent years, we've issued inflation-linked gilts, or index-linked as they're called. We've backed ourselves to return inflation to low levels. This is, and you're not going to be surprised to hear me say it, inherently stupid. This is proof, if it were needed, that not enough government advisors are reading or listening to the supplement. Had they asked someone who had done sufficient inflation research and analysis, they would have been issuing fixed price bonds, nominally, not linking them to inflation. How stupid can you be when the UK has blatantly been looking at a 3% plus inflation environment for over 4.5 years now? You're not using that to your advantage as a government should, and as a lot of our peer governments have done, aside from anything else, right? They have used nominal issuances of bonds, but instead we're being disadvantaged by the amount of inflation. The government should be the biggest winner here. It's just a huge, huge, huge waste of taxpayer money, and it's just one more gigantic multi-billion-pound opportunity missed by not running the country and the finances correctly. Now, if there's any doubt, to be clear, this is 90% the fault of the Tories, but Labour are continuing to compound this mistake by issuing more index-linked debt, as proven by this week's issue of Linkers. Stop it is my clear message. Remember, as I've said already, they're linked to RPI, not CPI, so it's been even more damaging. We paid for awful April, and we turned ourselves over more than anybody. Miserable stuff, right? So how about the 5-year gilts? Well, a fairly volatile week. The summary from the S&P Global Chief Business Economist framed things pretty well, it seems. We opened at 4.062 on the 5-year for the yield, and in spite, we had a real push to get the yields below 4%. We touched 3.984 on the Tuesday. The market was mostly sideways and closed to 4.046. Thursday's close was 4.031, which compared to the 5-year swap rate of 3.701. So the discount this week was only 33 basis points. But remember, it's only one snapshot of one final trade on a Thursday night, so don't worry too much about that. And that compared to 3.649% 1 month ago, so 5 basis points above that, and 3.842% 1 year ago, so we're 15 bips down on a year ago. It's pretty flat, realistically, over the last year or so. There's been up points, as you'll remember, when we get to that point in the year when we look back on those couple of spikes in the year. The bond vigilantes are the words to remember. You'll see those when we get there. So the ready reckoner for our 5-year limited company fixed rate mortgage debt looks like about 5.7% or so. There is a little bit cheaper than that out there at the moment. That's for limited company buy to let. But overall, a drop of 0.016 in the 5-year gilt for this week. Nothing really. How about we check in on the longs? Well, on the 30s, this week opened at 5.478 and closed at 5.453. So the yield curve got a tiny, tiny bit shallower this week, although only a very small amount, because that was about 2.5 basis points different. We gained a whole basis point on the 30s versus the 5 years. Still, it's not the wrong direction, because the 30s stay particularly high, and the yield curve still looks ominously steep, suggesting that we've got a rough ride ahead when we start looking at decades rather than quarters. So in a way, a bit of a nothing week in the gilts market, but not in the right direction. We didn't go in the wrong direction on the bright side. 1 basis point the right way is better than the wrong way. So into the deep dive this week then, because I've had a month on the spin of keeping a very, very close eye on the Chancellor at a critical time. There's actually now a chance to review a few recent industry reports, which I'm going to seize with both hands. Firstly, I want to catch up with some recent Hamptons International research, which is usually good quality, about renting and about generational divides. And there's another one on flipping, which I'd like to comment on as well. And then I want to take a look at the Savills revised house price forecasts, which I've got a bit more sympathy with than quite a few of the other purported forecasting houses out there. Savills don't do the worst job by any means, that's for sure. So, scuba masks on, oxygen tanks full. Here we go. 3 Hamptons reports. The most recent, their rental growth forecast, which they downgraded from 4.5% to 1% this year across Great Britain. Feels like a bit of a knee-jerk reaction to me, although there was a very clear point earlier this year where rents had really found their level. Properties were being advertised at prices that were just too high, and tenants simply did not look interested. Most portfolio landlords I've spoken with have agreed with some or all of that. Hamptons saw a 2% rise in rents for newly let properties to December 2024. The first point of order that I need to make, or as always in these circumstances, is that is for new rents, right? It's not the rate of existing rents, which have been increasing a lot faster, as evidenced in the ONS statistics, which I report on each month. Hamptons have got London rents down 2.5% for new lets, Wales down nearly 1%, and Scotland down 0.5%. They saw rental increases on new lets at 8.1% 1 year ago to June 2024, But in June 2025, that year-on-year increase was clipped back to 1.8. So how do Hamptons explain all this? Well, first-time buyers are driving the shift, they say. A record 33% of homes sold to first-time buyers in the first half of 2025, lowering tenant demand by 11% and put tenant demand down to 20% below 2019 levels. Now, this looks way out of place with Zoopla, Rightmove, and the RICS Residential Market Survey reporting, which is not showing anything like that level of drop, and indeed has tenant demand today still well above 2019 levels. My own gut feel within my portfolio would be I would agree with the latter, and I think Hamptons are in a very strange place, pretending that ultimately they are 20% less tenant demand than in 2019. But I do often accuse Hamptons, when I do look at things, of being too focused on the south. So this could just be an inherent bias down in the south somewhere where they're they sell expensive stuff. Their data is going to be concentrated in the top end of the market. Is rental demand down 20% in the top end of the market? It could easily be, right? I don't know. So I'd love to know how they control their data, if they do, based on the inherent geographical bias they have within their office locations. They say supply of homes to let was up 8% in H1 2025 as well. Not because there's been an increase in investment, although it's clear that it was much larger than Q1 2024, because that's what the buy-to-let data shared from UK Finance have said, but because there's been this slowdown in tenant demand. Tenants exiting the rental sector to become first-time buyers are not being replaced at the same pace, we are told, which if you put that together, I can believe that, and I think that is correct, and I don't see that point being made anywhere else. So I see that. It's just not clear whether the supply of property is going down faster than the supply of potential tenants, and how many hurried in to grab the old stamp duty, before April the 1st. Because remember, the first-time buyers were the ones hit the most by these changes in the stamp duty, because you were no stamp below 425k, and that went down to no stamp below 300k. So that was going to make a difference of £7,500 to a first-time buyer, who's probably the very most sensitive person in the market anyway, and has the least spare money to consider as an FTB. And those first-time buyer houses between 300 and 425k and above are much more likely to be concentrated in areas where Hamptons have offices, apart from anything else. Many first-time buyers, the average first-time buyer property is about 225k. So, a good 70-ish% of first-time buyers would be paying below £300,000 for a property. That needs to be borne in mind, but of course not, depending on your geographical location, right? They also say at Hamptons that pressure put on by higher interest rates has abated, and thus there isn't as much need to pass on the higher cost to tenants. Well, it's definitionally true that anyone who secured an interest rate on a 5-year before July 2022 is 60% or more of the way through that mortgage now, right? So 40% have still maybe got a bit of a shock to come, or dropping off the healthy, the generous rate, so those 5-year fixers. But the other 60% have already had their shock. And the 40%, if they've got half an eye on the ball, have of course had time to absorb these understandings and raise their rents in the interim, preparing for this big increase in monthly outgoings, if they've got any business sense anyway, right? Hamptons on their own have rental stock down 34% and tenant demand down 20%. So that explains that differential there, comparing to H1 2019. And I think rental stock down 34% again, that's a big number. And I wouldn't be surprised if that is the case in the south, where it's much more difficult to hold leveraged property anymore, simply because of where the interest rate is. That wouldn't surprise me too much. But we haven't lost 34% of rental stock throughout the country, although things are not great. They're not quite as bad as all of that. They're measuring that by the number of applicants anyway. I hope they're measuring it by the number of applicants per property rather than just the number of applicants, but that's not really made clear in the data. They also make the point the loss of jobs in hospitality and the graduate sectors, or probably the lower number of opportunities to go in, I think probably we should say, feeds directly through into the rental market, because both of those tend to be households that rent rather than own. They also say earnings growth has cooled more than anticipated. Now, I'm afraid I've got to call them out on this bit, because that is abject nonsense, right? The number for average weekly earnings growth first broke 4% on the upside in December 2020 and spent a lot of time between 6 and 8%. It first printed below 7 in November 2023, and it actually dipped back to 4.1 in August 2024. It went back up to 6.1 and is hardly languishing at the moment at 5%. This is absolutely not earnings growth cooling more than anticipated. This drop-off in wage growth has been much slower than the Bank of England or any of the economic forecasters have predicted. They then cite that the Bank of England expected to cool to 3% next year. Again, that's not true. They used a 3.5% figure in their last report from the decision makers panel, which they trust quite a lot. This is business leaders and business people locally telling them what they think wage rises are going to be, or in large corporates where they're negotiating a long way ahead in next year's pay rises, they already know what that figure is going to be, right? And that figure from the DMP has been between 3.5% and 4% for at least 9 months now, but we're still printing 5% at the moment. So bear that in mind. Nevertheless, let's press on. They then get regional. London down 2.5% year on year, leading the way in rent reductions. So rent reduced on new rents by 2.5%. But in May 2022, on Hamptons figures, the London rent rising for new rents was 20.6% year on year. Clearly, highly unsustainable. London, as so often, shows a similar pattern to the rest of GB, but with more amplitude, more noise in the waves. So it's often the highest or the lowest increase, and it doesn't spend a lot of time in the middle. The Midlands, for example, is still at 3.3% increase year on year, according to Hamptons. Hamptons renewals are coming through at 3.9% up year on year on rents. That's the tenancies that are being renewed, while we still have a world where tenancies get renewed before the Renters' Rights Bill. A renewed tenancy is showing a 6% average discount compared to 12% in June 2023. That's a significant difference. Excluding London, Hamptons have GB up 1.9% year on year and up 4.8% on existing rents. So not as stark as the ONS figures, for example, but still some insight and some data as one of the larger players in the market sees it. Next up, their flipping index report from quarter 1 2025. And as often, this was an interesting report that was badly analysed by commentators that I saw have a go at it. First up, the key is the definition. What is a flip? According to Hamptons, it's a home bought and sold within 12 months. The same home, right? So a few things to say. The advent of different types of additional homes, for example, of stamp duty, and then the subsequent ratcheting up of those rates from 3% to 5%, and also the overall freezing of the 2014 thresholds of stamp, plus the brief hiatus on SDLT, particularly between 125k and 250k, for about 2.5 years or so. That was from when Liz Truss came in to when it was phased out in April this year. They're all going to distort this picture, right? So it's not apples and apples, this sort of stuff. Then you've got to compare the speed of conveyancing. You know, it's not slower today than it was during some points of COVID, but it's certainly not faster than it was in 2019. So bearing all that in mind, there's a definition used in the report, and the definition is at least congruent since 2008 when they started reporting on it, even if the market conditions have and do change. The low number of properties that hit this threshold, 2.3%, is the lowest it has been since 2013, which is, miraculously, the low in the Real House Prices series that Nationwide publishes on a quarterly basis. That was a market with very little confidence, although 2013, the market was absolutely roaring in London, so again, regionally, it changes, right? How many flips by this definition were there in a context of a market doing 1.1 to 1.15 million transactions per year? 7,301. What's the 10-year average for a quarter 1? 10,000 flips. So volume's down 27%. Why? Well, pretty easy when it comes to motives, really. Lower margins. Ultimately, most people are flipping for profit, right? Nearly all of them. Or in more detail, a larger share of the pie goes to the government. But before we even get to how the pie breaks down, the average gross profit on one of these 7,301 flipped properties was 22k. Now, what I'd like to see here is everyone that sold for less money in the 12 months actually reduced from this sample size, because I think that would improve the data, because ultimately very, very, very few people have bought a flip for profit and end up selling it for less than they bought it. They might not make a profit because they've got frictional costs, they've got holding costs, but normally they'll sell it for more than they bought it for, because they've got to put money into the property normally to flip it. So I'd rather see that average with the loss makers taken out. What do I think the loss makers are? I think they're people who have bought a house and then sadly split up in their relationship. There's been a life event. something has changed and the property's then been got rid of effectively because it hasn't suited the family's needs anymore. Bit of a generalization, but I think that would clean up the data nicely. Anyway, that's just the difference between the bought price and the sold price, 22k, right? And that gross margin is actually the highest since 2022. But the graph, including the average stamp, tells a really interesting story. So I've used that as this week's graph. And if you look at it, look at the gap. Go on my LinkedIn, check out the written version of the supplement. You'll see the gap. It's quite incredible. But bear in mind as well, on many of these sorts of transactions, there's lawyers' fees on the way in, on the way out. And sometimes, if it's a flip, auction house fees and the likes, right? Then you've got an agent to sell it on the back end. You could have a rough stab at those costs. I'd be stunned if they didn't, on almost any flip, come to more than £5,000. And that's with none of any of the auction house business, right? Then you might need to remember, most often these properties need to be improved. Well, where's the room left in the budget for improvements? So on the very far right-hand side of the graph is the forecast. And this is really quite incredible. The average stamp duty paid on a flip goes from 6,375. That's the property sold in quarter 1, 2025. So they will have been bought between quarter 2, 24 and Q1, 25 if they've been flipped sort of super quickly, which doesn't happen very often, as you know. But most of those will actually, if not all of them, will have paid the 3% additional rate of stamp. I mean, there'll be the odd person who's doing it in their personal name to avoid stamp duty and additional rates and blah, 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 riding the lightning and whatever. But we can pretty much assume they paid the 3% rate before the October 24 changes. Then there'll be any of the ones that were bought after 1st of November or 29th of October, as it was, and have been sold again. Well, they will have paid the 5% rate of stamp. So that's going to move from 6,375 in Hamptons. That's the actual figure for quarter 1, 2025 in average stamp paid, to £11,920 stamp on the average 2025 flip. And then, of course, 2026 will be even higher again because those quarter 1, 2025 transactions, purchases, will drop out the sample at the old rates before the stamp was reintroduced on the 125k and above properties. So that's going to go up even more for 11,920. But what we're basically saying is Hamptons are forecasting basically a gross profit of 22k for flips in 2025 with £11,920 paid in stamp duty. So more than 50% of that gross profit is going to go in SDLT, which if you take my £5,000 as face value of slippage costs, frictional costs, whatever you want to call them, in and out, you're at like 17k already of 22,000 profit, and you haven't put a single pound into refurbishing the property in any way, shape, or form, or making it look good. I mean, it seems unworkable, doesn't it? So this is before tax as well. Bear in mind, if you dare to make a profit and it's income tax, CGT shouldn't really be CGT if you're flipping it under 12 months, folks. You're being naughty there if you're thinking like that, or corporation tax if you're doing it within a company. And I haven't already mentioned bills, holding costs, double council tax most likely. I mean, goodness me, there just won't be any flips anymore, will there? Trading, sub-sales and the likes wouldn't show up in these figures, bear in mind, because if a house is bought and sold in the same day, that won't hit the land reg. But if you had to settle on it to then resell it at auction, as some property traders do, then it would show up in the figures. But to put that into percentage context, as Hamptons do, the average return, so gross profit minus SDLT, was 7% of the purchase price. That compares to a 16% return if you use the same methodology in quarter 1, 2015. So that's more than a halving of the margins. And stamp is just going to end up killing the flipping market altogether, certainly when it comes to houses in the £250,000 plus bracket, and increasingly in the £125,000 plus bracket, which of course is covering an awful lot. So how did this manifest itself in London? That would be the classic expensive market we would consider. 1.5% of properties sold were bought within the past 12 months in quarter 1, 2025. 10 years ago, that was 3.2. Two of the top 20 local authorities for flips were in the south of England, Great Yarmouth, which price-wise behaves as though it's geographically north, and Torridge, which is the most deprived area of Devon, if you don't know. And again, they're sitting below the line in average house prices. So they might be in the south technically, but they're very much in the economic north of the UK. And flips will surely fall even further in Q1 and Q2 2026, because apart from anything else, what's the last hope, the last bastion of hope, the last ingredient that I haven't included here is prices actually going upwards. And as discussed, the forecasting houses are putting their expectations down for price increases, and we're not seeing it yet, although I very strongly believe the ingredients are there, as I'll go back to a little bit later on, right? But it's surely going to fall first into Q1, Q2 2026 and be in the doldrums until we've got true evidence that the market is really surging forward at 5% plus per year. Because if you haven't got the wind behind you, you've got a very limited chance indeed of making a profit. Okay, one more piece from Hamptons research before we move on, because I write with remarkable frequency about the media tropes around house prices and the fallacies that are baked within them. As discussed and analysed, the data at the moment shows house prices at a 12-year inflation-adjusted low. And frankly, that low 12 years ago was an aberration after a 2008 beating for the housing market. The real true last low was really 2003, which also coincides when houses were trading at the same multiples of earnings as they are today. And actually, we've got a more favourable income tax system. Don't laugh too loud, but we have, right, compared to 2003. 22 years of it not getting harder, just looking at prices to buy a house from today. But there are differences, of course. Mortgage rates, are they different? Well, not so much between 03 and 2025. It's easier to get mortgages at higher loan to value, simply because they exist, apart from there's much more product competition in the marketplace. And the high LTV stuff had kicked off in 2003, but it was still relatively nascent, right? Mortgages as a whole are harder to get because the regulatory environment is much tougher in terms of underwriting on mortgages. There was every chance I remember getting a mortgage in 2001, for example, whilst I had a bar job. And so did my brother at the time we bought that house together. But we didn't even know what a self-cert mortgage was at the time. The broker just sorted everything out for us. And as he was the vendor of the house, he was quite motivated to make sure it all worked, interestingly enough. Wouldn't even be allowed to do that these days, I wouldn't have thought. Mortgages are also more expensive than they have been in the years 2010 to 2022 because rates have normalised. So even if you don't point to the price itself, there are other factors that do make it hard today to own a home. Harder than other points since 2000, but we're a full generation, or arguably a bit more, away from the last time house prices in isolation looked this good for buyers. What about pre-2003? Well, if you didn't already own, you didn't really ride that wave. If you bought in 2003, you've ridden it up and back down such that inflation has taken away all of your paper profits. Still not really a problem if you've used leverage, because those loans have been at nominal values, not real ones. Geographically, there would be differences. Owning in London between 03 and 13, in spite of the national figures, would have been highly profitable indeed. Whereas owning in London between 2015 and 2025 will have had nothing like the same impact on your wealth. And in fact, you might sell it in real terms for less money than you bought it for. Almost certain to be honest. Hamptons go a little bit further. They open their piece on the generational divide in house price growth by claiming that the first-time buyers of 2020 are the first generation to see house prices fall in real terms during their first 5 years of ownership. Again, I've probably got to call them out here because this evidently isn't true, of course, but this is because they've picked some random years for their first purchase for various generations, including baby boomers and things like that. They haven't analysed every 5-year period because it's pretty obvious if you bought your first house ever in 2006, 2007 and 2008, then in the first 5 years, you almost certainly lost money in nominal terms, let alone inflation adjusted terms, unless you're in one of those great bits of inner London. But even then, the 06 purchases won't have done particularly well at all, right? Now, Hamptons have the 5-year house price index from the ONS at 27% upwards, but inflation adjusted house price growth at -3%. Their numbers: average buyer who bought in 2020 has paid £73,866 in average mortgage payments over the 5 years, with £58,986 of HPI growth, house price index growth, and they've paid £34,308 in interest as part of those mortgage payments. So on the basis that the average home in 2025 prices costs about £1,300 a month to rent, which it does according to the ONS, your alternative would have been £78,000 in rent. Now, that's not the argument they're making here, but it is useful to put that into context before we feel too sorry for anybody who bought their first house in 2020. Now, there is an element of validity to the overall point, right? After inflation, the average baby boomer deemed to have bought in 1979, according to Hamptons, as the average first-time buy for a baby boomer, saw a 35% real return after inflation in the first 5 years of their home ownership. The average Gen Xer, like me, who bought in 1996, I wasn't fortunate enough to be buying it that early on, saw a 44% return after inflation adjustment. The average millennial who bought in 2011 only saw a 13% return after inflation. However, the boomer paid 98% of that 5-year rip upwards in mortgage interest due to interest rates at the time. The silent generation paid 79%. That's before capital repayments on the mortgage, right? So massive rise for the baby boomers, all of it paid in interest payments, right? So the 2020 purchase at 58% of the HPI gain paid in interest doesn't look too bad at all, does it? And there are further nuances, as you might imagine. Longer mortgage terms, much more interest paid. That's obviously a big issue for people these days because it's the second half of the mortgage where that really bites. Shorter terms in the days of yore meant you're front loading to the tune of about 60% of payments paid in the first half of the mortgage and 40% paid in the second half. These days, it's much more like 50-50 or even 48-52. Millennials, it was much worse as it goes ratio-wise, but then you didn't have the high nominal prices alongside the normalised interest rates. They did at least benefit from those lower interest rates. It's a lethal cocktail for Gen Z. How would you get around this if you were advising your Gen Z children or you're in Gen Z and you're watching this video? What would you do? Well, what I would do is I would pay my mortgage down to the point where I'm paying at the stress tested rate already, because you're scored at the stress test rate. If you overpay by that much, you will be able to get back to that 60-40 payment structure or even better by overpaying and save yourself years on your mortgage. Now, if you're like me, you've leveraged your own property in order to invest in other properties, that advice does not necessarily apply. So just bear that in mind. But so what? Well, Hamptons see this as the end of an era for using house price growth as a cash machine to pay for cars, holidays, and home improvements, particularly in the early years of mortgages. And they say this filters then through into lower GDP, because certainly booming house prices in the 80s fueled economic growth, and in the 2000s until that came crashing down, of course. And so the natural conclusion from this is people are going to stay put. If you lay a stamp duty onto this, the transaction tax that almost every sensible analyst absolutely derides and criticises, there's two very good reasons not to move. Not moving then drags on the activity in the real estate sector in general, and also means people settle and stay in jobs rather than being geographically mobile, all else being equal. Another drag on economic growth. Hamptons closed this article with a throwback to the 2019 Labour Party, who suggested that the house price growth target could form part of the Bank of England's remit, looking for a low but positive figure with low earnings, but meaning you don't have market conditions that trap new homeowners. Interesting, but with no control over the fiscal side of it, and SDLT, for example, I'm sure the Bank of England would be pretty upset about that target as a general rule, because they'd just be telling the Treasury they need to change the stamp duty regime. But the lack of this targeting and the moves made by Rachel Reeves, as analysed in the past few weeks, I believe mean we'll soon have a buoyant market, which will actually iron out this problem for one election cycle or 10 years or so or whatever. But of course, it just kicks the can down the road one more time, unless the interest rate can be brought down by good factors, such as economic growth and confidence improving in the long-term future of the UK economy, or bad factors such as weak economic performance, increasing unemployment, and even yield curve control. Now, I don't think this administration in the UK will engage in any particular yield curve control, but I do think it's much more likely in the US, as I've been saying, once they've got Mr. Trump's stooge as the chairman of the Federal Reserve. And the US bonds are likely to filter through to the UK anyway. One more report from the past week before I leave it that I wanted to share with you in context with all of these, and that was from Savills, right? They revised their house price growth forecasts, and they made a big revision. They were also at 4% for 2025, and they're also down to 1%. There's quite a bit more to it than that, though, as they see 24.5% now as the number over the next 5 years. So bear in mind, if you think this year's 1%, the 4 years after that, they're looking at over 5% growth a year on average in the remaining 4 years of their forecast. So that's pretty bullish. Now, I agree with them. Not on the 1%. I still think we're going to get 2.5-ish, between 2 and 3 at the ONS, the official figures that I will respect by the end of 2025 when we've seen them. That's my revision down from 3.75 to 2.5, although I don't really do revisions, as I said. I just think they're still underestimating how much inflation is going to drive house prices forwards in a secondary way, right? The 24.5% is a higher number than the 23.4 they predicted before. Even though they shaved 3% off 2025's forecast, they've added about 4% back on somewhere. It's also not necessarily congruent with their recent piece that I talked about that was published around the impact of the relaxation of the stress tests and the loan to income rules, leading to the average borrower being able to borrow £28,000 more than they could before. Sav's analysis led to them concluding that 5 to 7.5% would be added on to the price growth forecasts. Or perhaps it is congruent, 3% off this year, 5 to 7.5% added over the next few years. That still doesn't balance that to 1%, but never mind. Right, it's close enough, maybe. Sav's expectations include another period of speculation before the autumn budget impacting house prices in H2 2025, but also having a negative impact on the consumer overall. So I agree on the bad news part. I also think the consumer will have it harder this time around than businesses last time around. But I'm not sure the first-time buyers specifically will suffer much here, or the second steppers. If you hit pensions and you hit savings, that's what we've been talking about happening in this budget. Home ownership becomes more important, right? And the incentive to keep funds in an ISA will be watered down. But that will primarily hit the population over the age of typical home moving events, other than a downsize, in my opinion. You know, most people get into their mid-30s, late 30s, 40s, and have made their moves, generally speaking, right? Average age of a first-time buyer, 34, perhaps one move into then the house that they stay in until they're 70 plus, pass away, go into care, whatever. That's the general pathway. You know, people move about an average of once every 22 years, but they move much more often in the early part of their moving career. They might move once every 5 or 6 years at that point in time, and then people tend to settle. And as they've probably reached the lid of what they need or what they can achieve, bearing in mind their career paths and all the rest of it. So Savills 5-year forecast year by year, 1% this year, 4% next year, 6% in 27 and 28, and 5.5% in 2029. Now, I can promise you the Labour Party would be delighted if that's what plays out. They see transactions at 1.04 million this year, which looks evidently wrong already, to be honest. I think the portals will be a lot closer with their 1.15 million. And then they move up to 1.15 to 2 million in the remaining years of this parliament. So still an accelerating housing market for transactions. Now, that side of it definitely looks sensible. I just wouldn't be surprised if we saw more than 1.2 million, right? I think we might see some 1.3s and things like that if things do race forward as much as is being said. And they also see base rate of 3.75 by the end of this year, which is the current market prediction, and then 3% in 2026 and 2.5% in the remaining 3 years of the parliament. Well, that would be a nice following wind for Labour, although I'm not sure the bond yields on the longs would appreciate those sorts of lower rates. They're seeing GDP growth at 1.2. That's the IMF revised forecast, as I said earlier, for this year. I think we'd be lucky to take that. I still think my forecast at the beginning of the year was about 0.75, sitting between 0.5 and 1 because of the drag effect that the national insurance increases would have on our economy. And I still think that looks more accurate than a 1.2 hopeful. They see 1% in 2026. That might be a little bit bearish. You know, I hope it is a little bit bearish. It will all depend on how much of the rubbish has been absorbed in 2025. And can't say too much for 2026 before I see the October budget this year round as well and see how that is going to impact things or not. Also, the OBR are going to say some fairly positive things about the financial deregulation thing, I think, as far as economic growth is concerned. And then SAV's moved back more towards the OBR sort of figures of 1.6% rest of this period. If you ask the OBR, the Bank of England, anybody like that, they would tell you, you know, chugging along okay for us these days. Looks like between about 1.6 and 1.7%. That's where we'll be. So a fairly hopeful economy, or maybe just an economy with an absence of crises to deal with, whether they're exogenous or whether they're self-imposed by putting things like employers' national insurance up. We've got a bit of a slow motion car crash going on over the coming decade or so, ramping up of defence spending, because the population do not capture a lot of that value. We get about 50 pence back, they're the more bearish estimates, for every £1 that we invest in defence spending. We've also got the population ageing, which of course happens very slowly, and we've got this alarming trend towards disability benefit claims, which has not really been addressed by what this government have done. They also go regional, so they predict that the northwest, which I've said recently is maybe having a bit of a stall. They see that as their top performer over the next 5 years, moving up 31.2% over the period. And they also see London lagging at 15.3%. I really am not sure about this sort of analysis at all, because I think the loosened mortgage rules benefit people in London an awful lot more. I don't think the market's done a lot down there for 10 years. If you went back 10 years in time, I was saying London's hit its peak. It looks pretty obvious. I'd be personally investing in the northeast and the northwest and places like that. People said I was stupid at the time, but all I was saying was past performance is definitely not a guarantee of future returns. And it was very obvious that it had overachieved over and above the economic growth in those areas. Now, the northwest has got some pretty good regional economic growth, but it's also pushed forward a lot. So I definitely wouldn't have it at the top of where I am on all of those things, right? I'd have it more towards the middle, to be honest, the northwest. And London, again, I'd have it more towards the middle or towards nearer the top because of what's going on in the market, right? So I think they've just continued a load of trends here. They haven't really done anything other than that. Sure, yeah, look, London is unaffordable. What about all the rich people that are leaving, blah, blah, blah? There's an article in the FT today actually about questioning some of this data on how many millionaires are leaving the UK. What a surprise. They're not real arguments. They're not being made with real substance and real data, right? But they go on to talk about the key drivers here. The first up is stamp duty, and they say, underestimate a Brit's love for a tax saving at your peril. Spot on. But their analysis really shows that Q2 just balanced out Q1, which is something we've been saying for all the reports and everything we've been reading and discussing on here. And we can't really read too much more into that, I don't think. It's not out of line with what I've suggested over recent months. They then discuss mixed signals from short-term indicators, which has to be related to point one as well. Weak demand reported by RICS in the residential market survey. More accurately, not strong demand, but middling demand, actually. If anything, their graphical representation of new buyer inquiries versus new sale instructions from the RICS report just show things converging together very much and actually setting up for a pretty even market from here, starting from a base of having a lot of stock in it, though, which is true, right? But let's see what the August clear out does. Let's see if new inquiries are going to start trending above new instructions, which does look like we're at that point in the graph at this point, right? So if I was a betting man, I'd suggest July's report will contain more inquiries than instructions, according to RICS, for the first time since August 2024. Savs do note that Rightmove and Zoopla's reports from May said that the sales agreed were the highest in number for several years. But in terms of beyond 2025, Savs then lean, as everybody else does, on affordability. Again, this absolutely classic known truth that isn't actually as correlated to house price growth as the availability of credit is just the sector being the sector. Nobody challenges it. It makes sense, so they say it. The rest of the report does rather read like Savs found the most dovish report they can cite on interest rates, Oxford Economics that is, saying that base is coming down to 2.5 in comparatively short order, and they've then used it. They do note that Dave Ramsden, the Deputy Governor at the Bank of England for Markets, noted the use of the word uncertainty moved from 20 times in the August 2024 MPC report to 112 times in the May 2025 report. But what they have correctly identified in their analysis, definitely, both in this specific report and the one about regulatory nudges and changes, in that now the conditions are very much created for a house price acceleration, even if it is not a full-on boom. If rates are to be dropping, and that filters through into the 5-year bonds, we're nowhere near as sensitive to the long bonds as the US market is, remember, because their mortgage rate is set by their 30-year bonds. Conditions for that shorter term do look good, which feed through into the housing market. So what did we learn? The bigger players in the market are bound to look to the likes of Savs, who are one of the very well most respected and very much one of the most prolific in terms of releasing research in order to make their decisions. This report will attract yet further investment into UK residential property across the board, because those juicy 6% returns will attract attention. Hamptons made some good points about generational issues in home ownership, but it's fascinating to see just how much of that growth was swallowed up in mortgage interest payments for the silent generation and the boomers. They essentially all had unaffordable mortgages by today's standards, but were saved by the booming market. And that's why when the wheels fell off in 1989, it was a long, long time before the recovery really bit. Now, after inflation, right, it took until 2002 for house prices to come back to 1989 levels, 13 long years. And then since that 2002 point, as I've said, prices have hardly moved up at all. But where you still are then is what was considered and deemed unaffordable and unworkable in 1989. But then at those times of double-digit interest rates, it looked very different to, we're saying we've got high interest rates today at 4s and 5% and things like that, whereas realistically they're half what they were in the late 80s, right? So that's one of the big changes in the housing market since then. We also learned just how stone dead the stamp duty regime is killing the flipping market. Not that anyone will do anything about that for years, if ever. And then the Hamptons are equally bearish about the 2025 housing market outturn. It's easy to be bearish, but as I've been saying, almost all the analysts are forgetting that inflation, remember our last point on CPI was 3.6, expected to go upwards, not downwards, is going to have an impact. And in a world of 5% plus wage rises, which are, expected to trend downwards, as we've been saying, but they've still been there in the first half of 2025, a 2% plus rise for this year is not going to be unusual. And time will tell. There's only 5 months until Christmas, folks, anyway. Yes, I went there in July. But before I do close, please don't forget to book your super early bird tickets to the next property business workshop that Rod and I will be running on Wednesday, the 1st of October in central London. This time around, investment metrics and how to run your property business at scale, my favourite topic of all. Book in the link in the show notes or at bit.ly/PPWEIGHT. So above all, please remember to keep calm, always listen to the supplement, of course, and carry on. There's going to be opportunities abound this year. Flat markets are great for trading in. And then beyond that, the landscape's been set for a surefire bull run. It's going to be slowish to get off the ground because it's property, right? And the amount of stock is still keeping things suppressed at the moment. But as yields currently continue to improve, it's a case of here we go, in my opinion. Thanks for tuning in, folks.